Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Johnson & Johnson quarterly report. Johnson & Johnson provides a wide range of healthcare products and services through two main segments, innovative medicine and medtech. The innovative medicine segment offers prescription medications for various therapeutic areas, including immunology, rheumatoid arthritis, psoriasis, infectious diseases, HIV/AIDS, neuroscience, mood disorders, neurodegenerative disorders, oncology, prostate cancer, lung cancer, cardiovascular and metabolism, diabetes, macular degeneration. The MedTech segment provides medical devices for various purposes, including electrophysiology products, heart recovery portfolio, circulatory restoration products, neurovascular care, orthopedics portfolio, hips, knees, trauma, spine, sports surgery portfolios, advanced and general surgery technologies, contact lenses, ACUVUE brand, intraocular lenses, TECNIS for cataract surgery. Johnson & Johnson distributes its products to various customers, including wholesalers, hospitals, retailers, physicians, nurses, eye care professionals, and clinics. Johnson & Johnson's stock price has seen a significant increase of 23% over the past year, driven by several key factors. The company's strong financial performance and outlook have been major contributors to this growth. Johnson & Johnson reported robust second quarter earnings, exceeding analyst expectations for both earnings per share, EPS, and revenue. Additionally, the company raised its full-year guidance for sales and adjusted EPS. The separation of DePuy Synthes into a standalone company is also seen as a positive strategic move, allowing Johnson & Johnson to focus on its attractive and growing businesses. Furthermore, promising results from clinical trials of several new treatments, including nipocalimab for Sjögren's disease and icotrokinra for psoriasis, have generated excitement among investors. Analyst optimism has also played a significant role in driving up the stock price. Several analysts have upgraded their ratings and boosted target prices, with some setting targets as high as $212. Overall, Johnson & Johnson's strong financial performance, strategic business moves, and promising new treatments have contributed to its increased stock price over the past year. The primary drivers of revenue growth or decline can be summarized into several key areas. On the growth side, increased investment from recent acquisitions and commercial investments, as well as the monetization of royalty rights, have contributed to a significant increase in revenue. Additionally, lower acquisition and integration costs, along with a gain on sale of securities, have also positively impacted revenue. On the decline side, intangible asset amortization expense has increased, while research and development expenses have decreased as a percentage of sales due to specific expenses related to securing global rights for an antibody. Litigation-related expenses have also decreased, primarily due to charges from talc matters in 2024. Furthermore, changes in the fair value/sale of securities and restructuring charges have negatively impacted revenue. Overall, these factors highlight the importance of strategic investments, cost management, and litigation outcomes on a company's revenue growth or decline. Net income and profit margins. A shift in fortune, the financial performance of a company has undergone significant changes between fiscal 9 months ended September 29, 2024, and fiscal 9 months ended September 28, 2025. Net income increased by $11,053 million, 104.6%, during this period, indicating a substantial growth. The third quarter also saw an increase in net income of $2,694 million, 92%, further solidifying the upward trend. However, profit margins have not followed suit. Gross profit margin decreased by 1.3% from 69.3% to 68%. While operating profit margin increased by 20.4% from 19.3% to 39.7%. The mixed results can be attributed to various factors, including market fluctuations, hedging activities, and inflation rates affecting worldwide economies. The impact of these external factors has led to a decrease in profit margins, despite the significant increase in net income. As the company navigates through these challenges, it is essential to monitor and adapt to changing market conditions to maintain profitability. The company is generating positive operating cash flow, indicating a strong financial position. In both 2025 and 2024, the net cash flows from operating activities were substantial, with $17,221 in 2025 and $17,283 in 2024. The operating cash flow for 2025 was $3.4 billion, further demonstrating the company's ability to generate sufficient resources to fund its operating needs. This positive trend suggests that the company is well equipped to meet its financial obligations and invest in future growth initiatives. The company's financial performance reveals a notable shift in its debt and interest expense levels. Notably, the debt level has surged by approximately $9.2 billion through senior unsecured notes issued in 2025, contributing to an overall increase from $35.8 billion to $45.8 billion as of September 28, 2025. Conversely, interest expenses have decreased significantly, dropping from $1.25 billion in Q3 2024 to $1.15 billion in Q3 2025. This trend is consistent with the company's planned leverage decrease from 3.0x in Q3 2024 to 2.8x in Q3 2025. The company's financial performance varied across different segments and regions. Notably, the innovative medicine segment saw strong growth in oncology, particularly with CARVYKTI and DARZLEX, which performed well globally, including Europe, Asia-Pacific, and Africa. The medtech segment also showed promise in U.S. oncology. On the other hand, some areas underperformed. IMBRUVICA sales declined, while STELARA faced biosimilar competition, leading to a decline in sales. Additionally, immunology and infectious diseases segments experienced poor performance. Management is outlining several key strategies to ensure the company's financial stability. To mitigate risks, they plan to manage foreign currency fluctuations through derivatives. Additionally, they aim to optimize corporate expenses and leverage investments in the innovative medicine business while phasing out certain assets. The company also intends to maintain its quarterly cash dividend payments and has sufficient resources to fund operating needs. The company's financial activities involved significant acquisitions and divestitures in the given period. Acquisitions included a total of $2,846 million related to goodwill on page 11. The acquisition of Shockwave for an unspecified amount on May 31, 2024, page 29. Intracellular Therapies, Inc. was acquired for approximately $14.5 billion on April 2, 2025, page 38. Divestitures included a total of $29 million related to goodwill on page 11. Johnson & Johnson Consumer Inc. ceased to exist in October 2021 as part of a corporate restructuring, page 22. Confidential settlement agreements with various parties in August and July 2025, pages 25. Disposal of assets/businesses, net $0.4 billion on page 38. These transactions demonstrate the company's strategic efforts to expand its portfolio through acquisitions, while also streamlining its operations through divestitures. The company's financial summary reveals that it has engaged in two key shareholder return initiatives. Firstly, the company has paid out a significant amount of dividends to its shareholders, totaling $3.132 billion, as per page 3 of the report. Secondly, the company has also opted for share buybacks, returning approximately $1.904 billion to its investors through this means. That concludes the financial summary for Johnson & Johnson. Feel free to comment below, and I will be happy to answer them when possible.